Good evening from sunny South Africa. My name is Ed Higginbottom. I'm Managing Director of Verdant Capital, and it's my pleasure to join you remotely and share some of our perspectives around investing in Africa, especially investing in the financial services sector. Verdant Capital, we're a Pan-African investment bank and investment manager, and we really specialize in financial services and financial technology. I'm going to talk to everyone today about three key themes: technology, fintech, capital raising in Africa, and thirdly, M&A consolidation. Firstly, fintech. Everybody is a fintech now. And that sounds a slightly flippant statement, and I mean it flippantly. So most financial companies looking to position themselves in the market, one way or the other, as a fintech. Clearly there's shades of gray, tech-enabled financial services, tech-enabled credit, all the way to TechFin, as Ant Financial like to describe itself. Everybody's looking for that positioning. Everybody's looking for that positive gloss in terms of valuation that positioning can give you. From our experience, investors are quite discriminating now in terms of where a investment opportunity lies on that continuum I mentioned. Investors are quite discriminating in terms of what is a vision or strategy to transform or bring more technology into a traditional bricks and mortar financial business. What is a very specific plan? And then thirdly, what is actual implementation? And ultimately, most investors are looking for a technology transformation which is actually being implemented, or a business which is, fully integrated. And what do I mean by a technology plan? Loan life cycles change to reduce costs, so that the OpEx per loan is reduced. Platform type businesses, app type businesses, where there's a meaningful amount of cross selling, additional value added services which are sold through those apps. And ultimately, investors want to see a benchmarking. They want to see a benchmarking of these key parameters, whether that's the number of loans per loan officer, loan volumes per loan officer, whether that's the amount of non-credit income or fee income or cross-selling income. Investors want to actually empirically measure the degree of being a fintech. Secondly, the capital raising environment in Africa generally. If we look at the last 10 years, listed equities has been weak for most of the continent. If we look at the last 4 years, private equity has been weak. Fund sizes have been smaller year on year. In fact, probably about half of all the big name Pan-African private equity funds, about half of those funds are now out of the market, either out of the market permanently or out of the market at least temporarily. But it's not all negative. We've seen more and more diversity in the private capital market in Africa, more investors with sector specialist funds, more investors with country or regional specialist funds, more investors targeting very specific types of assets or very specific layers in the cap table, mezzanine, hybrid type funding. And this is probably a good thing. It's a reaction from the limited partner base to fund performance in Africa not being strong enough, and the greater degree of specialization, I think, provides limited partners with, from a development bank perspective, more control of the development impacts. It provides them with a more specialized underwriting team that hopefully will imply stronger fund performance. And from the point of view of a potential investee company that's raising capital, an opportunity to meet with a potential investor who have a greater degree of specialization in considering the opportunity. Third key theme: M&A and consolidation. We see more M&A, more consolidation. Partly that's driven by volumes in private equity. The big funds raised 10 years ago, big funds raised 5 years ago. As that investment cycle matures, there's more assets being exited. And that applies to the financial sector as well as other sectors in the economy. We also see it driven by entrepreneurs. In terms of capital raising, a bigger size is a better multiple. And the quickest way to get to that bigger size is by M&A. So there's a lot of pull factors driving M&A, mergers and acquisitions. There's also push factors. A lot of entrepreneurs are nervous about competition. Take the fintech sector, for example. More regional players are consolidating, growing larger. More big raises from China. Capitalizing competitors. Regional telco businesses are getting into payments. For example, Airtel Money has been spun off and is likely to become a fully fledged financial services company. MTN may do the same with their mobile money business. We see global payments companies getting involved. So that competitive threat is, to some extent, it's a push factor. We have clients at the moment we're raising capital for whom the status quo is not an option. Either raise a lot of money and compete on a more or less level playing field with your competitors, or we exit. We exit and move on and do something else. It's good to be the best, but it's better to be the biggest. We see that theme in terms of the big raises. People such as OPay, raise money at very aggressive valuations from SoftBank a month or so ago. Driven by the size and scale they'd achieved in Nigeria, the largest economy in the continent, and a bias in that direction. Great pleasure to share some perspectives. My name's Ed Higginbottom, Verdant Capital. If we can help, if you'd like to talk about investing in the continent, if you'd like to talk about raising capital or M&A, please reach out to me. Look up Verdant Capital, and we'd be glad to continue the conversation.